Broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and good morning to our friends in Australia. And a couple of hours later, after midday in New Zealand. Nice to have you with us. Excuse me. And Pete, over in Auckland, my friend. Pete, thank you. Loud and clear, eh? Good. Everyone's happy with the volume today. Great to have you with us, folks. And Rustin, hello to you. Tom Janovic, have you had a chance to do a long-term chart on the markets? Well, I certainly can, Tom. You let me know which market you're interested in. I can certainly do that for you. Anyway, great to have you with us today, folks. I mean, crikey, 30th of June, end of the financial year. There must be sunspots and flares and everything. I mean, we've had endless problems with our technology, and my apologies for not getting the midweek chart updates posted. There's just computers have been on strike for some reason. They're all right now, and we're getting caught up. Terry's actually with his children up in Toronto at the moment at the baseball, having a nice day. And Michael, my friend from Melbourne's up in Port Douglas having a long weekend up there. So everyone's having a great time, and me, I'm just hard at work like usual. But great to have you here. But boy, the drama we've had with Brexit. We've got an Australian election tomorrow. Double dissolution of both the Houses of Parliament, the House of Representatives, the lower house, and the Senate. Just endless drama. Banks in Italy are falling over. Probably plenty of others to follow in the Eurozone. So just massive amounts to talk about today. Okay, so let me see if I've clicked all the buttons. We've got good volume and everyone can hear. And I've remembered to press the recording button, so that's all good. Okay, so let's, yeah, that's all good. And we're recording, blah, blah. Okay. Can you all see the screen, Pete, over there in New Zealand? You see the screen all right? Everything okay? I've got a button on here saying it's not showing. Have you got it? Let's have a look at the audience view. Yeah, okay, thank you very much, Pete. That's great. I'm surprised you're not out on the boat. It's a lovely day today. Okay, let's move on. Let's first of all catch you up to date. If you don't know about Brexit, I'm going to tell you a bit about it. It's a great drama, high drama, and this is to do with the divorce between Britain and the European Union. Britain, of course, has been a member of the European Union for 42 years. During that time, there's been a lot of division within the Conservative Party, the Tories as they're called, with a significant proportion of the, thanks Janet, significant proportion of the Conservative Party MPs being unhappy with the deal in the euro. In the European Union, and Britain not actually in the currency union. They don't use the euro. They still have the British pound. But they've been an important member of the European Union for 42 years. And the background to all of this is there's been this disquiet in the Conservative Party, which is one of the two major parties in Great Britain. Labour's the other one, of course. This has been boosted by the rise of a small party called UKIP, UK, run by a guy called Nigel Farage. And he's an ex-stockbroker, which is kind of interesting. But his main push, he's been doing this for 17 years, and the world's been laughing at him, and journalists have been ignoring him and laughing at him because he's not seen as politically correct. His main push is anti-immigration or limit immigration. And those of you in Europe who follow affairs in Europe and Britain will know that immigration has just gone completely berserk. It's completely out of hand. It's the open borders policy that the EU It's part of their mantra, and of course Britain's suffered disproportionately because they've just had a huge, massive influx of tradesmen, all sorts of people seeking better working conditions, better payment, of course, over there. And this has been on the boil for a while, with the present Conservative government promising to get it under control, and of course the EU has just not allowed them to do that, and it's all come to a head. The political imperative is that the Conservative Party's been threatened by UKIP, Farage's Eurosceptic party, and with the rise of that group and also the dissatisfaction within the party itself, David Cameron, the existing Prime Minister, decided that he'd take a punt on a referendum. Now, politicians hate referendums because it means the public is making decisions, and politicians don't like to trust the public. And the real underscored message of democracy is that elected representatives make the decisions, and you and I really don't get much of a say. And when we do, it's likely to be a shock to them, and that's exactly what's happened here. Cameron was entirely confident that he could carry this referendum on Britain staying in Europe, and so he headed the Remain party, and excuse me, and then the opposition, that was the Leave party, Leave the European Union. And this contest played out last Friday. Eventually, the vote was taken between essentially Britain and the European Union. And the photo I've given you here is of Mrs. Merkel, the German Chancellor, who's a lot more attractive than Mr. Juncker, the head of the European Union. He's an ex-Prime Minister of Liechtenstein, who spent his time as leader of that country impoverishing his neighbours by having very low to minimal negligent taxation rates. But anyway, everyone seems to forgive these guys, and they go on to become unelected leaders of the European Union. One of the great complaints is that they are unelected, the commissioners of the EU, and that they can't be removed. And how that squares with democracy has been part of the argument. Anyway, we're now showing you the next slide here. I've got a few to go through, bring you up to speed. The cheery-looking guy with the ale in his hand is Nigel Farage. He's the leader of UKIP, the UK Independence Party, independence from Europe in particular. And the happy chappy giving the salute is Boris Johnson. And they're not exactly, they're on the same side of this argument, but they're not exactly colleagues. They're really competitors, because Boris Johnson's very much a leader of the Conservative Party, the ruling government, and Nigel Farage is the stirrer, the up-and-comer, running a very populist message. The interesting thing is that the whole world, other than the Daniel Code, was convinced that Remain would win, that is, that the Leave vote would not get up. And it's kind of weird, because markets just got it so wrong. And all of the polling was basically been 49-52, with a 3 percentage point error leading up to the later days of the referendum. You know, that's close enough to a 50-50. But anyway, these are the guys who led the Leave team, Leave the Euro. Boris, of course, if you don't know him, is a wonderful speaker. He's a raconteur. He was the Lord Mayor of London for 8 years, did a great job there. And I think this photo you see of him is actually the Olympic Games, which he presided over at London. Was just a wonderful event. Very popular guy, switched on guy. No one's quite sure of what his real politics are, other than self-promotion, but my guess is you can probably say that for almost all politicians. And we've got to change the screen here, and these two characters here you're going to hear a lot more about, Michael Gove and Theresa May. Michael Gove was Boris Johnson's wingman in the Leave campaign, and it was very much supposed that Boris is the most widely recognised politician in the UK. after the Prime Minister. It was very much supposed that Johnson would automatically become the leader of the Conservative Party. David Cameron, of course, the Prime Minister, was forced to resign after the referendum. As Hank's pointed out to me, Farage is the not only head of the UKIP party, he's a European parliamentarian. Thank you, Hank. Europe has its own parliament, of course. Anyway, this morning, or rather last night, when it was much supposed Boris Johnson was the short price favourite to become the next leader of the Conservative Party, with Michael Gove as his deputy, Gove shafted him very unexpectedly, put the knife in and said wouldn't work with Boris, and he's now standing in his own right to lead the Conservative Party. So at least he's a consistent character. He's been Justice Minister in the present cabinet in Great Britain. The lady on the right of the page, Theresa May, she's the Home Secretary. She's actually campaigned for the Remain group, but pretty low key, kept all her options open. She's viewed as an experienced hand, so the competition is now between these two characters here, both of whom are pretty grey and uninspiring. So, but you know, as someone one of the British cabinet ministers supposedly going to support Johnson and said he was going to support Theresa May, and one of the journalists asked him, why are you supporting Theresa May? She's not very exciting, is she? And he said, I think the country's had enough excitement for now, and that might be right. They've got a terrible hard task ahead of them now to negotiate their way out of the Eurozone, which is a bit of a misnomer. It's not that there's any difficulty getting out of the Eurozone. You just say you're leaving, and then eventually the European Union will give you an offer, which is a take it or leave it one on what access you'll have. But there's just all these issues. Young people voted overwhelmingly to stay in the European Union. I know my own children, we have dual nationality. We have the UK passports due to my father's nationality, as well as our Australian passports, and that gives you a right to travel anywhere in Europe pretty much without restrictions, to work anywhere in Europe without restrictions. And that's terribly, terribly appealing to young people and maybe older people as well. But really the vote to leave was basically older people. And it's quite a schism, 16 million to remain and 17 million to leave. It was just a huge, monumental result. Interesting thing is I was very, very confident that the leave vote was going to get up because the charts were screaming for leave. Here's the GBP USD. As you can see, it had had a big run up for the 5 or 6 days before the vote. There was unbounded enthusiasm. That was all on a TO3 buy signal. This is the British pound. And then it straight into the blue lines up there. And we had on Thursday night, 7:30 US Eastern Time, we had blue line sell signals for this market and others. That was 14 hours before voting opened. So we had this swag of blue line trades. Aussie US dollar was a sell for the Friday. Euro Aussie dollar was a buy. GBP chief was a sell. GBP USD was a double sell. So the charts were screaming for the leave vote to get up. And it's amazing how badly markets read this. It came as a great shock, and it shouldn't have. Markets were overwhelmingly positioned for the long side of this trade, and that's why it was so dramatic. But as you can see, there was some part of 14,500 or more to be made out of this trade if you had the Daniel Code signals. Here's the one of the other blue line signals for last Friday. I want to show you just how dramatic this stuff has all been. This is Euro British Pound. We had a blue line and a TO3 signal to buy this market, buy Euro GBP. You know, it's stunning, the drama. Look at the size of these bars on Friday and Monday. They're really quite extraordinary. It's been a wonderful, wonderful bit of trading. I didn't post last Friday, those of you who are interested, I didn't post sell signals for the S&P and the NASDAQ, etc., because I'd figured that the biggest impact, if the Leave vote got up, which my opinion was it would, in all probability, remember with markets like most of life, we're only ever dealing with probabilities. My thought was it would be far more lucrative to be in the Forex and currency markets than to be in the equities, and that's how it turned up. We did, in fact, had a daily sell on the S&P the day before, and I didn't repeat it because you can see where the entry point was, big risk, and I figured there wasn't going to be as much downside, and this market made about 4,500 on the best of the Brexit move, as opposed to about 14,500 in just one of the currencies. Here's a one that we were thwarted by. I did post the sell signal in the DAX, Germany's DAX. It's the main index for Germany's stock market in Frankfurt. Of course, we were thwarted by the fact that this is not a continuous electronic market, and it was closed when all the drama happened, and by the time it opened, it was all over, and we had this massive gap down. So we did have a blue line sell for DAX on the Friday as well, but it didn't come to fruition because the market just gapped down. That was it. But we were on the right side of it. I'm making the point that here's GBP JPY. Again, the massive great big bar is on Friday, and for that market we had a TO3 sell signal. I'm just reinforcing the point. These signals were all posted at about 7:30 US Eastern Time on Thursday evening. So, 12, 14, 16 hours before many hours anyway. I can't do the calculation in my head, before the polls opened in Britain for the vote. And you can see this trade, there was some part of $18,000 odd per one standard Forex contract available on those Daniel Code signals. So kind of interesting when we get this cluster of signals, which we sometimes do, that we get all of the markets, or a large percentage of the markets, lining up for a turn. That's when we often get these big moves. You see something like this if the central banks come out with a surprise non-scheduled announcement of any importance. But this was absolutely a beauty. Wonderful way to finish off the year's trading, and was just quite marvellous. So I hope all of you did very well out of this. If you didn't know that Leave was A, very likely to get up, and B, was going to be so prosperous, then you should just make sure you pay attention to the Daniel Code trading signals, because they will keep you on the right side of the markets almost all the time. This next chart I'm showing you is the FTSE. This is the London's, Britain's major stock index, and kind of interesting now to see what's a little bit of the dust has settled. There's still, don't kid yourself that this is over. The repercussions are still to come. There's a lot of hidden news that we're not hearing yet. There's a lot of forces at work in these markets, and there will be all sorts of dramas coming out over the next year. This has set a precedent, and it's going to take a long time to work through. But interesting how little reaction this had on the FTSE. As you can see, it had its massive, 50 down to 5,700 from trading at about 6,400 before the Brexit vote. regained a whole lot of that intraday, and since then it's just straight been up, making new highs. Nothing to worry about. Stay calm and carry on, as the British say. So the British stock market certainly enjoying all of this. It's on this chart, at least in the shorter term, it's very happy with things, and there's a reason for that, and the reason is this chart that you're now looking at, which is the long-term trend chart on the British pound US dollar. This, in fact, is our longest term trend chart. This is a 24-day chart, which means every one of these bars is 24 days. And as you can see, we showed you this chart some time ago, well before any of this latest drama happened. And we had the dotted line on there showing you where most of the stops were. And we had the two red lines, which are fourth seal lines, forecasting future price and time. And as you can see, we were looking for a number somewhat below 131.36, which was the next Daniel code number down. And extraordinary with all of this drama that was going on, with almost every other form of analysis, when there's huge volatility, it just blows the support and resistance levels to pieces. It just goes out the door. Not so with the Daniel code. The more volatility there is, generally the more accurate it is. So this huge, unexpected, by everyone else, crash in the British pound, look where it went to. We had a Daniel code. The next Daniel code number was at 131.36, and we have a nice crossover of two Daniel code fourth seal lines just below that number. So I wouldn't be surprised to see a little false break below 131.36 before there's a rally. Now, bear in mind that the week or 2 weeks before the referendum came out, the IMF estimated that this GBP currency was 12 to 18% overvalued. So it could have, even with this big move down, it's nowhere near where it should be technically. And in due course, my guess is we will see this market get down to the black line at 115.35. And don't forget, this is good news for Britain. We have a general world view of the economies at the moment that there is massive overcapacity caused by the rise of China and India, the rise of these great manufacturing nations, coupled with unlimited liquidity from central bank policies, generally very low interest rates, money sloshing around everywhere for the chosen corporates, and that's led to this massive surplus of industrial capacity. So that's what the world's starting to shudder about now, is we have this massive overcapacity and it's not being fulfilled. The real economy, that as opposed to the paper economy, hasn't grown enough to take up all that capacity, and so we're finding real problems with price steel, where the price of Chinese steel has dropped through the floor, and everywhere else in the world except Australia, which has tariffs on it to maintain the old price. No reduction in our steel price at all, even though steel companies are going broke and getting subsidies from the government. That's what you call a command economy. We can't let the steel makers be out of work, so we'll just whack on tariffs and keep the steel price where it used to be. And we're seeing this overcapacity in all countries. So one of the ways economies and countries individually can deal with that is to weaken their currency. And almost all economies are trying to weaken their currency within the constraints of the various trade treaties they have. Those of you who follow these things closely will remember that the chairman of the Bank of Japan, the president of the Bank of Japan, was spoken to very harshly by the US Treasury for jawboning, trying to jawbone the yen weaker. And Japan's got a real problem. They want a much weaker yen, because a weaker yen, of course, makes your exports so much cheaper and more attractive, and it makes your imports more expensive. So it works very strongly in favour of your national balance of payments. And that's why every country is trying to get their interest rates down. So this is actually a boon to Great Britain for British manufacturing and exporting. This is great, and the lower the British pound goes, really within reason, the better it is for them. So there's no bad news about this side for Great Britain. The country that is not able to do that, which we'll come to later on as we work through these slides, is Australia. And Australia has a twofold problem. First of all, it's pretty much hollowed out its manufacturing industries, and it was very reliant on iron ore mining, coal mining, digging up things from the ground. No added value, just stick them on a ship and we'll sell them overseas. And that's been encouraged by government policy, very short-sighted. And of course now the mining boom is over. The price of iron ore has collapsed. The price of coal has collapsed. And as the price of steel is collapsing, so the demand for those commodities is going down, down, down. So Australia drastically needs, and things are really slowing down in Australia generally, Australia desperately needs a lower currency. But it's got a problem in that it's a net importer of foreign capital. Australia is a huge borrower. Australian banks with an implied government guarantee, the four major banks, the four pillars, as Costello named them, they are huge borrowers, as is the government, of overseas funds to pay for infrastructure. And worse than that, they're now using borrowed funds to pay for day-to-day running expenses, which all of you would know in your own businesses and your home budget is a quick way to instant disaster. So Australia's got a problem in that they are keeping interest rates artificially high, as are New Zealand, 2.5% sort of stuff, which doesn't sound much, but when effectively the other major economies are at zero or near zero, it's a significant differential. So the Aussie dollar is staying strong, very strong for its real underlying basics, because of the fact that it's an attractive place to park your money, 2.5% or more, 3.5% to money managers is a big deal when they can get next to nothing in their own country. So every country is trying to devalue their currency, except Australia, which jawbones it, says they'd like to see it weaker, says the Reserve Bank. But the reality is the interest rates compared to world rates are so high that they're making it attractive for people to buy and invest in Australian-denominated bonds, etc. So try and keep those two different pictures in your head as we move on, and see what else I had here to show you. This was the latest news. It's only out this morning, that the Italian banks are in real trouble, have been for a long time, but because they're in the European Union and have some sort of implied guarantee from the European Central Bank, they've been able to hold on. And today, an announcement just hours ago that €150 billion bailout program has been approved for Italian banks. Now, this is quite illegal. It's completely against any of the rules of the European Union, but being the funny chappies they are, they pretty well make up the rules as they go. They can do what they want to if they really want to. So what you're seeing, that chart, that's the Milan, that's the main Italian share market. And as you can see, it had its crash down into late 2008, March 2009 with the rest of the world, and it hasn't really recovered at all. It's just gone sideways, and there's an awful lot of this trouble in banking with bad loans that haven't been recognised, the usual tricks. We've seen it all before, and it's on big time in some of these countries. and being covered up by the European Union people. So you've got Spain, Portugal, Italy, absolutely desperate. Greece, of course, is just not even hanging on by its fingernails anymore. It's just a broken creditor of the reliant on the creditor nations, Germany, mainly to keep funding it. So there's a whole lot of drama that hasn't come out yet, but Brexit has been used in this case because these bank bailout and business bailout powers are not available under the European Union rules except in extraordinary circumstances. So Italy's got in quickly to say this is an extraordinary circumstance, and they're going to, not without a bit of pushback from Mrs. Merkel, they're going to somehow wrangle 150 billion euros to bail out their banks. There's going to be more of this coming, folks. As Warren Buffett says, when the tide goes out, we can all see who has been swimming naked. Now, this is chart should have just changed for you. This is a oldish chart. This is only up to second quarter 2015. And this is what's heading down the road for Australia. This is what's going to break its back. Those of you who read my articles will know that for many years I've been talking about how ridiculous housing prices are in Australia. And all of this huge boom in housing prices is actually a structural thing caused by really two main events. One is the change in social habits, that women are now an integral part of the workforce, and women, poor souls, I guess they fought for this, they got it, which is always wise to say, be careful of what you wish for, you might get it. And in the not so olden days, women got married, had children, looked after the household, maybe helped in the husband's business. Now they're expected to work, pop out the children, stick them into play school and get back to work as soon as possible, which I'm not sure that's such a great thing. I know it doesn't happen in my family, but anyway, good luck to those who do wanted that and have got it. But the big change with this change in social habit has meant that housing income as a family unit has essentially doubled. And that's what's given rise to this extraordinary liquidity that allows this Australian housing bubble to develop. And I was writing years ago that Australian housing finance was not running at the prudent no more than a quarter of your income being spent on mortgage payments. The value of these mortgages that have been running were more like 10 and 12 times the household income, or at least the prime income earners' income. And this chart here only goes until second quarter 2015, so it's a year out of date now. Capital city prices in Sydney and Melbourne have gone up close to another 30% since then. It sounds extraordinary, but the point I want to make is that household income hasn't gone up much. Construction costs, according to this chart, haven't gone up much, but I think that's misleading because we've got this extraordinary thing in Australia of labour. The minimum wage, the basic wage here is $17.50 or $18.50, something like that. Don't hold me to the exact cents. Whereas the minimum wage in America is about $8.50. So housing in Australia costs basically 4 times the cost of housing in France, to give you a bit of a line through that. And this is being fueled by debt. And the other interesting point that's driving all this is what's called negative gearing. Americans will be familiar with this because in the States you're allowed to deduct the interest on your house against your income, which is a nice trick. I wish we had it here. We don't. But what we do have is that if you're an investor, that is, if you're buying a second, third, fifth house or property, if you declare it as an investment, you can deduct the interest on investment housing against your income. And despite what Mr. Trump says, Australia actually does have the highest taxation rates in the world. You only think they're tough in America. They're tough enough, I know, at some levels, but Australia 50%. Once you get a decent income, better than decent income, I guess. What this is showing you is that net income from investment housing has been negative for years and years and years, and it's much more negative now. This chart ends in 2012. So you've had this combination of government policy working to make investor housing more attractive, it's the housing prices here are just ridiculous, worse than the US was at the height of its bubble, and it's just pricing young people out of the market. All sorts of financial tricks are being done to try and keep finance to first homeowners going, with state governments granting them 15, 20,000 just straight out of the taxpayer's pocket. So we don't have anyone here to shout about how ridiculous things are. We have a socialist country with two governments, essentially two main parties. Essentially, there's no difference between them. The only difference is that the conservative or right-wing party, who are called the Liberals but are not liberal, they favour big government, big business, I should say. That's why Rio, Microsoft, Google, Uber, you name them, pay effectively no tax in Australia. The government's allowed that to happen with full knowledge of it. There's some band-aid solutions being slapped around, but when you hear that the tax commissioner is going to discuss with these companies what level of tax they should be paying, given their past performance of paying nothing, really, it's just been a rounding error. They've been transferring the profits out of the jurisdiction. It's sort of a bit creepy. I don't think anyone from the tax office is going to have a discussion with you or me or the man in the street about what level of tax we should be paying. That's the law, chum, and get on with it. But anyway, they're the big business is the clientele of the Liberal National Party, in the same way that trade unions are the clientele of the Labor Party. So we have these two socialist parties that light socialism, I guess you could say, although the tax burden's horrendous. This is an example of real economic distortion caused by tax decisions, and it's not going to stop. It looks like the Libs will get back in again at the election tomorrow, and they have gone to a great deal of trouble to maintain the facade that this negative gearing on investment property is a reasonable thing for the country, and to make sure that stays in place. Don't forget what I was telling you, that you have this massive amount of money gone into home mortgages, completely unproductive. 82% of all Australian home mortgages are owned by the four big banks that enjoy an implied government guarantee. So this is really the effect of government policy, and no one's screaming about it. There's very little comment about it. What comment there is pretty muted, and it looks like we're just going to be stuck with more of the same. Folks, there's our compliance document I always like to show you. Make sure you're aware that there is real risk in trading futures and commodity markets. If you don't know how to trade the Daniel Code way, you have more risk. You need to really understand the risk of trading before you risk any real money with it. Okay, now if I'll get out of this, I had a ton of charts to show you. Let me see if I can bring those up. Okay, let's have a look. We're going to start with some of our 12-day charts. I really want to try and get an impression across to you if I can about these long-term charts we don't spend enough time looking at. This is the GBP US dollar chart, which I showed you in the slides. But have a look how marvelously this has found the Daniel Code support. You know, this is supposedly a drama. This is supposedly unprecedented. This is the breakup of the Eurozone. This is a very, very orderly market. Look where it went to. 130, 136 was the next Daniel Code price level down. Hit that and stopped at it almost perfectly. Those of you who look at the daily charts will see it's even better. But it's extraordinary, isn't it? So I want to run through some of these daily charts and give you a global view, really, of what's going on in the world and what we can expect. I think I've told you that we will expect to find a little bit more support from this market just a bit lower down at these fourth seal lines, although one of them, as you can see, is actually right on the low of that bar. So that might be the short-term low already, if not a lot further to go before some sort of a significant bounce. But eventually I expect this market to work its way down to the black line at 115.35. Let's have a look while we're on the, that's a 24-day chart. I want to go to the 12-day charts. And show you some other charts. This is the Milan index. This is the Italian stock market, as you can see. It's a sick puppy, and that's with all of this banking nonsense having been covered up by the European Union, who the European Central Bank maintain they've stress tested all these banks and they're all sound, which is, you know, fantasy land. And the worst of these banks is Deutsche, the big German bank. They've got all sorts of hidden problems with derivative positions. Let's have a look. Let's open this up so we can find, let's find it. Indices. Let's start by having a look at the CAC. And this is the French stock market. Here it is. I did have a dollar CAC. I did have a, it might be easier if I just show you this on a Word document. Here we are. Save us scrolling through all those, be a bit faster as well. So this first chart you're looking at, you should be able to see it now. This is the CAC. This is the French stock market. As you can see, it's putting out trouble signals. It's actually trading below 2 standard deviations from the mean. It's had a nice big rally since July the 11th, all perfectly contained in the Daniel Code trading channel, except for the one breakout in November. We're now getting consistent closes below 2 standard deviations from the mean. And that signifies further weakness. Now, there are elections coming up in France later this year, and expect to see lots of drama from the Marine Le Pen, the right-wing anti-immigration Brexit equivalent, if you like, in France, pushing for a referendum and limits on untrammeled immigration. Here's the next chart. It's the DAX. This is Germany's big index, and it's very much like the S&P, only a little bit stronger. It's dived down to its 2 standard deviations from the mean, and it's held there. We don't have a close outside 2 standard deviations from the mean on this chart, but we're seeing an ongoing battle to hold 2 standard deviations from the mean and get back to 1 standard deviation from the mean. That's very normal behavior. This is London's FTSE, this next chart. This is the main share market index in London. You can see it did pretty much what the S&P did. It had a close below the 2 standard deviation. This is the 12-day charts we're looking at. And then had a little rally. You can see that the drama from Brexit meant almost nothing to this market. It took out those lows, went nowhere near the old lows, and is now roaring up. It's trying to recover 1 standard deviation from the mean. And the lower the GBP goes, against its trading partners, the more strength this market will get. This next market's the IBEX. It's one you probably don't look at. This is Spain, and as you can see, it's a bit like Italy. It's really the story of the two halves of the Eurozone. Germany and some of the northern countries are doing very, very well. Southern countries are just in absolute endless loads of trouble. And that's a direct function of the value, the strength of the euro. That one of the challenges is that you have a common currency, but you don't have financial union or real political union. So the European Central Bank, pushed and prodded by the various politicians, has to make a decision about what the value of the euro will be. And inevitably that will be a compromise. And as it is, that compromise is such that it's far too strong for the southern countries, Spain, Portugal, Italy, and it's too weak, really, for the northern countries, Germany and North. So those it really divided the whole euro into two areas, if you like. Those that have a more favourable policy setting with the euro are doing extremely well. Those that aren't are in endless trouble with no real prospect of them getting out. So how Spain and Portugal and Italy resolve these issues, I don't know. But I think that's the great joy of it all. You're going to see more and more dramas. You're going to see more and more fallout from Brexit with other countries, right-wing groups pushing for their own referendums, etc. All of which has the capacity to spark a bit of chaos. And being traders, we love chaos because chaos brings volatility. And I think you're going to see a lot more of this before the year's over. This is the Shanghai Composite in China. This is a very, very phony market. It's got wild speculators, wild punters. I mean, this thing just goes nuts and then collapses. So as you can see, there's plenty of drama still there. Of course, China has all of its stuff, including its stock market, under very strict control. This next chart you should be able to see now, folks, is XJO. This is the Australian Stock Exchange Share Price Index, which is the this S&P version of it, the top 200 companies in Australia. Now, this all looks pretty good because they've had nothing like the recovery in the States, of course, but they've worked their way up solidly from the 2009 crash, and they've just sort of been flirting around the bottom of that one standard deviation from the mean. This is a pretty broad trend channel I've got on here, just to illustrate how it's been supporting this market. And I think trouble is not far away for this market. I think we could finish up with a hung parliament, or at least a obstructionist Senate in this next election. No one's terribly impressed with either of the major parties. In fact, the average punter is pretty well sick and fed up with them, and we're not a demonstrative country. It's pretty muted. It's more don't really care about it. What can you do? But I think we're going to find a pretty obstructionist Senate, and government's going to find a lot of trouble getting its legislation through. Now, remember that there's billions and billions of dollars in the Australian budget that's included in there in the belief that government will be able to pass the legislation. Now, a lot of that legislation's been sitting in Parliament for 2 or 3 years, and they've had no chance of getting it through. So if we have another government that had its will frustrated, we might see some real dramas. So watch this market. The futures code in Trade Navigator is AP. Lots of fun in there. Here's the S&P as we keep up all the time. You remember we saw it break 2 standard deviations below the mean, and I told you then that the probabilities were that we just had a great big sideways correction, and so far that's what we've had. This market's just hovering around the 1 standard deviation from the mean line. The bottom blue line is 2 standard deviations from the mean. The next one up is 1 standard deviation from the mean. And it's hovering around trying to hold that. If it can hold that, its next target will be the mean, the thicker blue line, as it tries to recover for that. But it's held on very well, and you'll see the reason why shortly. And this is it. Look at the NASDAQ. I mean, it's just been absolutely sensational. It's holding strongly within its 1 standard deviation from the mean. And for the last, these are 12-day bars, folks. So the last 1, 2, 3, 4, 9, 10 is about the last 4 or 5 months. This market's just been rotating between the mean and up a bit above it and 1 standard deviation from the mean. So this, but NASDAQ, just have a look at what this has done to the old 2007 highs. This is, American entrepreneurship, IT development, technology, all of those great things. The big unsaid here is that that's not trickle-down effect. This is benefits those people who are holders of the big NASDAQ stocks. And unfortunately in the States, as very, very much in Europe, we see this huge gap between the haves and the have-nots. We have it in Australia as well. We have it everywhere. And in all countries where manufacturing has been hollowed out, it's fine for politicians to say, oh, we're going to have a smart country and do the IT stuff. But that stuff's not suitable for a whole lot of people. And you really need that nice range of jobs. If you're talking, as Malcolm Turnbull is, about jobs where? What jobs? It's a real problem. It's a real problem. I don't think anyone has the answer, least of all me. Here's the US dollar. This is also a 12-day chart. We've been looking at this now since, early last year. We saw it hit our Daniel Code target 184, which is also the black line of a minor swing. And as you can see, this has been incredibly consistent between 93 and 100.84. This market is very much controlled by US Treasury. So if it's been that stable for so long, we can pretty well say, well, that's the policy setting. But the US also is desperate not to let their currency strengthen too much because it puts their own businesses under more and more pressure. This is the Huey chart, folks. I showed you this the other day, and I've probably got a big version of it that you'll be able to see more clearly. This is a 24-day chart, so it'll be in this little lot here. I'll find that for you. I know a lot of you are interested in gold. Huey is up here. Here it is. Right, and here's the chart. So I'll scratch this up a bit so you can see it. I did this analysis for you a few weeks ago for Kurt up in Canada, who asked for it. And I just want to make the point that these major chart patterns, this is a 24-day chart. Each bar is 24 days. These chart patterns take a long time to establish, and they run for a long time as well. If you just look at the periods between these, we call them staircases and waterfalls. If you just have a look at the periods between them, this ran for 32 periods. That's 32 24-day periods. That's a bit longer than 32 months. That's, sort of getting on for 2.5 years. This one here ran for 33 months. I think you get the idea. These very long-term patterns that take a long time to establish on these very long-term charts. This one ran into this bar here, another 33 months, getting on for that'll be 3 years. There's normally 22 trading days in an average month. These are 24 days because that's a Daniel code number. These trends last for very, very long times, and it takes a considerable market movement to turn them around and give you the new other side of the signal. So we're all the way back to 2000, and from in the 16 years since then, we've only had 4 buy signals and 3 long-term sell signals. 2 of them were waterfalls. 1 was the standard channel fail pattern. So these signals go on for a long time. So don't be at all surprised to see gold and silver go on and work to the upside for quite a long time. We had the black line of the minor swing on gold at 243.52. This bar closes in late July, I think, July 21st. So it's got another 3 weeks really to run until this bar closes. But if it closes above 243.52, then it's right into the major retracement numbers, 280 up to about 370. So you gold bugs, just be aware that there's a dominant buy pattern in this market that on the long-term chart has been there since March. Okay, the next one was Huey. That's the one I've showed you. GBP I've shown you. We've talked all about that. And now have a look at this. This is the euro. And the problem for the euro is that they can't get it weak enough. They've been trying desperately. Draghi's been trying desperately to weaken this, and it's just sort of locked onto that 104.953 Daniel code retracement. And it's very much tied up with the DX in the same way as I showed you. The DX is just running in that range between the 2 Daniel code numbers. This market's doing the same thing, and as long as it holds this strength, then this is very negative for European manufacturing. And here is the Aussie US dollar, which I think is going to give us some dramas. The Reserve Bank is holding this up through artificially high interest rates. It dare not reduce interest rates substantially because we've got the mother of all property booms going on. Any tick down in interest rates just fires up the next round of that, and an awful lot of people are going to get hurt when this property boom in Australia busts, as it will. The thing is, we don't know when, but it's something that I'm sure everyone is aware of, everyone intelligent is anyway, and the rest won't listen, so there's not much point worrying about them. But you have this duality that the Australian government is keeping interest rates artificially high. The 2.5% is not high in outright terms, but compared to zero or negative returns in other major currencies, it's a magnet for investors and health funds and wealth funds, I should say. So it would love to drop interest rates and see this currency weaker, but it can't because it's frightened of stoking. It doesn't need fueling. The property boom's going nuts, stoking an already ferocious housing market. So it's caught between a rock and a hard place with this. I thought in this first rundown from the stupidity we had in 2011-12 when we saw this currency worth more than the US dollar, I thought it would get down to that first black line you see at 67.79. It didn't quite make it. It got held up by the blue line at 68.87 and rallied from there with just a little false break. I think sooner rather than later we're going to see past 67.79. I think we're going to see 65, and ultimately this market before this great property bubble, the bust is over, we will see 54, 55 cents, but that's probably years away. These markets move very slowly. The fundamentals don't change until something makes them change. and I don't see that on the horizon at the moment. And that's the last chart I had for you folks, and I hope that's given you an impression of what's happening around the world. I hope that you get the feeling that there's all sorts of crises being hidden in the various countries, southern countries in the European Union in particular, that could break loose. I think we can have some economic turbulence in the States as the election cycle there matures. We might have some dramas in the next couple of weeks in Australia when the results of the voting for the House of Representatives and the Australian Senate on Saturday become clear. So I'm very hopeful that we're going to see lots and lots of chaos, lots and lots of drama, all of which feeds into volatility. Okay, I've got a few questions here. Let me work through them for you. Let's see who was up here. That was Tom. I've got his question. Jim Brown, early question for you, John. Definition question. Are TO3 trades counter swing trades against the major trend, which usually play out in 1 or 2 days, such as what's going on with crude right now? Let's find crude. I would assume then that the major swing now for gold is up. Yes, well, I'm sure that's right, Jim. The gold swing is up entirely. TO3 trades are, they start off as counter trend trades, but we have some mechanisms. We have some rules. Everything to do with the Daniel Code is a rules-based trading system. And if you come along to a tutorial, I'll be happy to teach it to you. But for example, this bar up here, 0608, bear with me while I look up that date in the book where everything is written down, because I'm a Luddite and I don't trust technology, so I write everything down. And there was oil, 0608. That date there was a TO3 sell. So that trade was not elected till the next day. And let's put a arrow on there for you. That was a T03 sell. Turn this arrow around so it's pointing the right way. This bar here, Jim, this is June the 8th. This was a TO3 sell. It was elected the next day. You didn't get a profitable close. The next bar down here, you got a profitable close. Okay. What you can't see on here, because the indicators are not here, is when this bar completed 0610, you could have exited and taken the first profitable close, but you would have seen by that stage, if you had done a tutorial, that was likely the start of a new trend, in which case you'd have held it with a 2-bar trailing stop until you got to the 1-bar trailing stop, which is down here. And then on this date, 0616, let me have a look at the book about that. You had a daily buy in oil. So this was a buy. So basically we got the lot in here. One of the biggest issues with trading is actually knowing what the trend is long-term and short-term. Short-term in particular, because if you can hold these trades for 2, 3, 4, 5, 6 days, that's the real cream on top of your trading. So being able to identify when we have a high probability of a change in trend is the key to bulking up your equity returns. And that's one of the main things that I teach you at Daniel Code Tutorials. So come along and I'll be happy to teach you that. That's right. Major swing for gold is up. Yeah, gold's on a tear. That's right. Tom Janovic would like an S&P and gold long-term charts and post them. Go volatility, Janet. You're quite right. Love it. Okay. Johnny Barnes enjoyed that. Excellent commentary. Thanks, John. Have a great weekend. Hey, great. Thank you. Jim said he stayed until 46 and change. 40. Oh, nicely done, mate. Very, very nice. Good trading. Great trading. Well done. Okay, folks, thanks for your company today. I hope I've given you lots and lots to think about. I'll look forward to seeing you at our next tutorial, which will be in a fortnight. I know that's not a common expression in America. A fortnight is 2 weeks. I look forward to seeing you then. In the meantime, please, by all means, shoot in your questions to me by email to jneedham@thedanielcode.com, and I will get the appropriate charts ready to discuss whatever it is that's interesting you before that next webinar. Don up in Canada, good to see you, mate. Nice to have you with us. Don Maydell and all of the rest of you folks, thanks for being with us, and I'll look forward to seeing you in a fortnight's time. Bye-bye.